In the 7.3 subsection of Chapter 7 of inflation, we're going to be studying the impact and measurement of inflation. So let's take a look at some macro consequences. The previous consequences we talked about were micro consequences. In other words, the changes in the price effect, the income effect, and the wealth effect were affecting specific individuals. Now we're going to be taking a look at what impact does the inflation have on the entire economy as a whole. So let's go through our little bullet statements together. So, turns out that there's uncertainty. I think everyone recognizes that when prices are changing, and they're changing by a lot, and some prices are changing quite considerably, but others are not changing quite so much, after a while you lose track of where prices are in the system. And so you can't really tell when you're looking at a particular price whether it's high or low, because the nominal number you're looking at has to be adjusted for all the other price changes. So anyway, societies that have lots of inflation have lots of uncertainty as people lose their ability to understand where prices are. The next issue, the next bullet statement is under speculation. It turns out that many people decide that it's better to be a speculator than it is to be a hardworking earner of income, because earning income just gets chewed up by inflation anyway. So to get ahead of things, people start speculating. Remember the example I gave of the real estate versus the bond, the corporate bond. Corporate bonds are normally thought of as nice, safe, easy to understand investments. You put your money in them, you collect interest over the years, and as long as there's no inflation, that's actually a pretty good investment. But if there's going to be lots of inflation, especially hyperinflation, meaning very high rates of inflation, over 200% per year, when you start getting those kinds of rates of inflation, you start to realize being stuck earning 5% when the prices around you are rising at 200% will put you so far behind that you'd be a fool to invest in a corporate bond. And so people stop making those nice, safe investments, and instead they start chasing real estate, for instance, and overpaying for real estate. Because when prices are rising so dramatically, what does it mean to overpay? I mean, I can remember just a few years ago, a perfectly nice house in Cobb County you could buy for $250,000 or less. Nowadays, you look at those numbers, I mean, there's no neighborhood I can think of where you can buy a house that inexpensively. So when you see a house that's a 1,500 square foot house selling for $400,000, is that an expensive house? Or is that what houses are going for now? You see the problem, right? It's very difficult to keep up with what is a legitimate price for something. So people start overpaying. They start trying to buy houses or whatever to get ahead of the next inflation episode, and then they overpay for the house, or they invest in the wrong kind of house. So the problem, of course, is, I hope you recognize from that one example, inflation starts turning people into speculators, and instead of doing the nice, safe, easy investments that get ahead in life bit by bit by bit, people start throwing caution to the wind and start looking for crazy type investments that they hope will have a significantly large enough profit on them to overcome the inflation. That's particularly dangerous for society, because it turns out all of society gets ahead a whole lot better if we stick to nice, safe, reasonable investments that pay off over time. Next issue on our list, bracket creep. Bracket creep refers to the tax brackets. I presume you all recognize from filling out taxes yourself, you know that there are different brackets depending on what your income is. And so bracket creep refers to the fact that, I'll use an example. Let's assume that you normally make $50,000 a year. And $50,000 puts you in the 15% tax bracket. Because as a $50,000 per year person, you're just an ordinary middle class person, you're not a rich person, so 15% is the reasonable tax rate. Now let's assume over a couple of years there's been a significant amount of inflation and prices have doubled and you've received a raise to $100,000 per year. $100,000 per year, which is double the income, is the exact same real income as the old $50,000, because if prices have doubled, doubling your income merely keeps you in place, doesn't it? You're not actually getting ahead. You're simply staying in place. However, when you go to fill out your taxes, the tax bracket now treats you as a $100,000 per year earner, and the brackets were built back when people making $100,000 a year were pretty successful, right? and instead of paying a 15% tax, we expect those people to pay a 25% tax. But you notice now that inflation has risen large numbers of people up to 100,000 who aren't really richer because they're paying, the prices they're paying are twice as high as well. All of a sudden they find themselves in tax brackets that only used to apply to rich people, but now they're applying to you as well. Because once inflation has taken place, a $100,000 income is not a high income anymore, whereas it was if you went back a few years before the inflation was there. So that's what bracket creep is. You very easily imagine people getting damaged by the inflation as they keep getting higher and higher nominal incomes to keep up with inflation, which puts them in rich people's tax brackets from just a few years ago. And then last but not least on this particular slide, your author wants to bring up the issue of what is called deflation. Because inflation means prices are rising on average, deflation means prices are falling on average. Everything we said about inflation, you can just reverse it for deflation. Let me give you one quick example, then we'll move on. So remember the issue about the house. There's two different investors. One chose the corporate bond, the other chose the house. They both cost $100,000 to begin with, but inflation caused the house price to go up, whereas the bond owner was stuck at $100,000. What if it was the other way around? Instead of having inflation, what if we had deflation? So the average price of most things declined 50%. So houses instead of costing $100,000 now only are worth $50,000. But the bond, which is written as a nominal contract, remains at $100,000. Now who would have been the better investor? If prices are falling, you'd be way better off locked into a fixed rate contract bond because it would continue paying you 5% of the original $100,000, even though the prices you're paying when you spend that $5,000 worth of interest, the prices in society are going down. You can afford to buy more and more and more stuff with your $5,000 check. You are a winner in that example. But what about the person who bought the real estate, planning on charging $5,000 a year worth of rent? Well, if prices are falling, the value of your rental property falls from $100,000 down to $50,000, but also the rent falls from $5,000 a year down to $2,500 per year. So clearly, if you had bought the real estate in deflation, you would have been in serious trouble. Whereas if you had bought the bond, your position would actually be improving. So you notice deflation and inflation are essentially mirror images of each other. They have exactly the same effect, just in the exact opposite direction for the exact opposite type of asset. So you have to recognize that inflation and deflation can cause either real estate to be the good investment or the bonds to be the good investment, depending on whether you're in an inflationary environment or whether you are in a deflationary environment. And since you as an individual cannot control inflation, you start to realize, oh my goodness, how do I make this choice? How do I choose between buying a bond or buying the real estate as my investment, when either one of them could turn out to be a really lousy investment, depending on whether we have inflation or whether we have deflation. Now let's talk about hyperinflation. From its very name, you know this simply means a very high degree of inflation. And if inflation means prices are rising, then hyperinflation means they're rising a lot. How much are they rising? Well, our author prefers the number 200% per year. That's a pretty common number to choose. That means prices are more than doubling, because 100% increase would double, so 200% would increase again. So by the end of the year, they would have doubled twice to reach 200% inflation. How high can inflation go? It can go literally to millions of percent. In our picture here on this particular slide, we are looking at a Reserve Bank of Zimbabwe. That's the government bank of Zimbabwe. This is one of their notes. It's $100 trillion note. Okay, that's trillion with a T. Unbelievable. That $100 trillion note, you might go out and only be able to buy a can of Coke with it. And we're not talking about you can go buy a whole country with it. This $100 trillion note is something that people have maybe 50 of them in their wallet, and when they're at the grocery store, you pick up some peaches, you maybe pick up a watermelon or whatever, and you use a $100 trillion note to purchase it because it costs that much. That's how much prices went up in Zimbabwe. And they started at a perfectly reasonable level where a watermelon would be $2 or $3, $4, $5, something like that. In the 1970s, by the year 2000s, prices of watermelons have skyrocketed into the billions or trillions of Zimbabwe dollars because of inflation. So inflation can be incredibly high. Several societies have been ruined by it. Zimbabwe's economy was devastated by it. Germany after World War I, devastated. Argentina has gone through several bouts of hyperinflation and their economy limps along. It's really been a major setback for their society. Venezuela is going through it right now. I'm using Venezuela in my examples because it's actually currently occurring. So if you want to actually look at that, go ahead and Google the inflation rate in Venezuela and just imagine what it would be like to be an ordinary working person in that country. It's a terrible situation. So how are we going to measure the inflation? First of all, before we get to the actual mechanics of it, we are going to figure out why we're going to measure it. So first of all, we're going to do two reasons why we're measuring inflation. First of all, just to know the answer. What is the average rate of inflation? How much is it happening? On a purely scientific inquiry, you might want to know. And then also from our previous lecture, we realized, well, inflation causes victims either as investors or as wage earners or as consumers going out to purchase. We realize that inflation can have different effects on different people. And so unless you know what the inflation rate is, you cannot calculate how much damage is being done to any particular person. So what method are we going to use? We are going to use what's called the Consumer Price Index, which is usually abbreviated as CPI. So in the future, I'll most likely just simply refer to it as the CPI because once you've heard it, you know that's what it means. So the Consumer Price Index is going to be a measure of the average price of consumer goods and services. We use it to calculate the inflation rate, and then the inflation rate, once the index number has been generated, we're going to calculate the inflation rate for any individual year by seeing what the percentage change in these index numbers are. So how are we going to create the price index? These index numbers I keep referring to. Well, the first thing we need to do is we need to create something called the market basket of goods. Now, the market basket of goods is a standardized list of goods and services that the typical consumer buys. So it's not a physical basket. Picture it, it's a metaphor for you have a market basket into which you put the things you buy. So picture in your mind all the things the average American would buy in a year. So we're talking about food items and entertainment items, gasoline, cars, clothes, vacation trips, and on and on and on. Well, somebody goes out and from the U.S. Department of Labor has professional economists who study these things. They do a survey of what Americans buy, and then they build this list from that survey. And then the next thing they do, our next bullet point, is you have to select a base year. You're going to define a base year as this is the reference year from which all prices will be calculated. So in other words, the year they do the survey of the market basket, they go out and price all those goods in the market basket, and they nail that down as this is the base year. And then every year after that, we're going to go out and reprice all those items to see how much the market basket has changed and how much it costs to buy the market basket. Now, to make index numbers work nice and easily, we're going to convert all of these market basket dollar amounts into the number 100 for the base year. And let's think about this for a second. If the average American family has an average income somewhere around $68,472.29, well, I got it close. That is not the actual number. I'm being facetious in order to realize how complex the number is. We don't want to work with numbers like that. And then the next year it's $72,479.28. Those kinds of numbers are difficult for our minds to wrap around. So we're going to index those numbers and convert them into the base year will equal 100, and then every year after, no matter what the real number is, we'll scale it down to a number somewhere close to 100 that would preserve the same percentage change between the two numbers. So when we actually go through an example, this should make more sense. So last bullet point, we're going to measure the prices for the market basket of goods, both in the current year and in the base year, so we have a comparison. Now, what goes into the market basket? Let's take a quick look. This diagram shows how the typical urban consumer spends each dollar. Now, urban should be put in quote marks because the word urban means something different to statisticians than it means in ordinary life. Urban includes the suburbs. So once you include the suburbs, you realize, well, you're talking about 90-something% of the population of America. It doesn't include everybody. There really are people who live in rural areas, but for the most part, we either live in a central city or the suburbs that surround the central city, and that's how we define urban. So pretty much any neighborhood you live within commuting distance of Atlanta, no matter what the name of the actual town is, we simply assume it's urban. So those consumers spend, as you can see, close to 33% of their income on housing, close to 16% on transportation, close to 13% on food, and on. I'm not going to read all the numbers to you, but you can see these are the big general categories. Then, of course, within those categories, such as, let's say, the entertainment category, 5.3. Well, there's a lot of different ways to do entertainment, aren't there? I mean, you can go to a Braves baseball game, you can go to FC United soccer, you can go to a football game, you can go to a rock concert. The number of ways of getting entertainment are almost endless. So we're saying is all those different choices fit within that 5.3% slice of your total budget for the average person. And then on with the other slices as well. So the Bureau of Labor Statistics breaks the entire budget down into these pie shapes of the general categories, and then within each category, they do further surveys to find out what specific items people buy so that we can get down to the actual item itself and then go price that item. Now we're in a position to actually compute the price index. Now, the price index is going to be computed using basket prices, meaning the market basket prices, between the base year, which is the year we did the survey, and some other year. So let's assume, just to make the problem simple, that we have a base year. We've picked it to be the year 1980, whatever, it doesn't matter which year it happens to be. It's the year we did the survey, and it works out that the average market basket costs $12,000 to purchase. Then what we do is the very next year, we go and recalculate the prices of the exact same basket. We don't change the basket to meet what people are buying this year. We simply assume they're going to be buying the exact same basket. Because remember, the purpose here is to figure out what the change in the prices are. So in this example, we're assuming that it now costs $13,200 to buy what last year you could have bought for $12,000. So that makes things pretty easy. Now we can compute a price index for the current year. And the price index is just simply a formula of the current year basket divided by the base year basket times 100, which we have worked out here in front of us. 13,200 divided by 12,000 times 100 gives us 110. So 110 is the index number. That's what we're searching for. It is now going to be the number by which we make comparisons for all other years. Now, it turns out the base year is always 100. Because remember, what's the formula for calculating the index number? Current year divided by base year? Well, in the base year and the current year are the same year, aren't they? So in the base year, you would simply have 12,000 divided by 12,000 times 100. So the base year is always equal to 100. Now you can compare 100 to the new index for the next year, 110. And that's a nice, easy number to calculate because that's just a 10% change from 100 to 110. So in this particular example, inflation was up 10% this year because the index numbers increased by 10%. And then now we can calculate the inflation rate from any of our, using the CPI, for any particular year, between any two particular years. They don't have to be the base year anymore. Now that we've got the idea of the base year, let's take a look at these 2 years. They're obviously not in the base year because neither one of them is 100. We see that in 2006, the CPI was 201.6, and in 2005, the year before, it was 195.5. So using the normal formula you use for calculating the percentage change in anything, we just simply take the formula that I've got listed here in the box. The inflation rate will be the CPI for year 2 minus the CPI for year 1 divided by CPI for year 1. That gives us the percentage change times 100, gets rid of the decimal points, and then you end up with a percentage number. Let's work through the actual numbers in the line above. We have what? 201.6 for the CPI of 2006 minus 195.3 times 100 over 195.3 gives us 3.23%. So from one year to the next, from 2005 to 2006, the inflation rate in the United States was 3.23%. You can do this, as long as you have the index numbers, you can do this for any 2 years at any time. And the Bureau of Labor Statistics publishes these. You can Google it online, and it instantly pops up a list of all the index numbers for multiple years. And so the inflation rate will just be the percentage change of any 2 adjacent years of indexes.